gonna go over this on the dashboard. Stuff that look crazy. This is a fake account. Fake money. No, I don't have $200,000. You'll see Thinkorswim.com, Charles Schwab, and then you'll go over here, trade it. You won't be using trades. Looking for options. Paper money is a little different. This is how you practice on the trades. Here we go, looking for the option trade chain. Okay. So we open there. You got puts. Center on strike. Strike price is the price you're looking at. This right here. 326.90. See what the price is of this Tesla. It's the stock we're using Tesla right now, obviously. It's at $326.90. See the buy, you see the sell, but this is not what we're using. Because we're buying calls and we're buying puts. Calls on the left side, puts on the right side. That means June 20th will be 6 days from now. You see out the middle, these are strike prices. This is what you're betting on price hitting. So we're at 326 already, and you buy $312 strike price. And a call you betting is going up. You already passed $312. So these are called in the money. Probability they stay in the money, you see it say 77%, 73%, 68%, 64%. As long as the price goes up, while you buy this, you get good money. How much do it cost? See right here, the bids and ads. $10.65 per share in $100 contract, not $100 contract, in 100 share contract. So each share of your contract costs $10.65. $10.65 times 100 is $1,065. So you was to buy this 325 straight, you'll be up. You have to pay for $1,065. This would be $1,190. $1,330, $1,480, $1,640, $1,805, almost $2,000. To the stock like Tesla, as it go up, so you can think about it like if price to go $327.90, this price, so this $10.65, $1,200, and keep going up. That $10.65 will now be at $1,330. It'll be different. Of course, this will be moving up, and it'll be going further and further into the money. But these are the out of money ones. So you know what's going up, and you know you're not trying to spend $1,000+, but you do think it's gonna go to 326 to about 340. 340 one costs $500. Well, you're trying to get it between $500 and $510. So as it's moving up, I got a probability that your bet that it'll get reached at $340 is a 30% chance that it's betting that it's going up. How do you buy one? Let's see. No, we're not doing that. Let's say we're doing an ask. They're asking for at this. You're buying a June. You're buying a June. This is June 10. This is on. You're buying 10. You're buying one June 20th. 327.5 call at $960. It's 9.60. All you doing, you buying. You put how many you want to buy. If you want to buy 4 because you're feeling good, you're buying 4 of these at $960. So you're spending 9, 8, 12, 9, 8, 27, 36. Then that's $6,000. Let's see. You'll be spending $3,840. Now, how much money can you lose? How much money you put up? How much money you can make? If the stock go to $400, you're a very rich man. But it's not going to do that in a week. You don't know. You don't really have to think about nothing. All you're doing is buying calls, buying puts, how many you want, which expiration date. So you're doing this, it'll be done by Friday, 13 days, 19 days, 27 days, a month plus, another week. Limit is what it's a fixed price that you're buying it. Like you don't want it no higher, no lower than 900. Market, it puts you in it immediately. Immediate price. So whatever it's at is how much it's gonna cost because you ain't trying to get left out. So if you do limit, you have to wait until somebody gives you the contract. Now let's say we was to bet that the stock was going down. It's vice versa. So price is at 326 and we believe it's gonna hit 320. We're going for a 320 put. So for 320 on the puts it on the right side. Boom. 320 put. $790. $790 for 320 put that they say got a probability of going in the money 41%. $790 got a 41% chance of getting inside this. This is what we really want. We want out the money to go in the money because big profits. Because once it hits in the money, the delta changes. Your delta changes. Here go the delta right here. This is every 50-cent dollar move, you make $40. You make $38 because it's only buying. You're making $38 every 50% move. Open interest, you see the volume. It got a good push. People was on this. They might believe that it's gonna drop to 320. You get closer, to leave faster just in case when getting it out. You see Delta is at 45. Probability in the money 48. If I can read my chart, I'm in it. It costs a little more because it's closer. It costs more because it's already close to being under that price. You know what I'm saying? The closer you is, the closer the stock is to the strike price. It's gonna cost more. It's really all you need, bro. That's really all you need. If you play the earnings play, you stay close. You stay close, or go. You stay here, or at least 3 to 4 out. But you can really know how far it's gonna go because we already know that we check the ATR, and then we double the ATR. Tesla ATR is, let's see, $19 a day. So we know that $30 to $40 move. $30 to $40 move. $40, that's like 280. I think Tesla can get to 280. Boom. 281 costs $72, $73. 6% chance that it's gonna make it that far because it's not earnings. So, but we know it's gonna at least go down $20. So let's go 300. You go 300. What's it cost? Because the probability a little more now. These are all weekly contracts. We got a week until it's out. What if you want to buy more time, more theta? Because you don't eat your contract up. It's gonna cost a lot more. It's gonna cost a lot more. Even if we go another week out, price is gonna be crazy. You see? Because when you buy time, you buy more security. It's good though. Because one day it might not move the way you think it's gonna move, so you have more time for it. Could move the way you think it's gonna move. But since Tesla been going up, 326 plus another $20, 346 call. Let's see, we look for 346 call. How much some shits cost? $890 for a call next week. Because you got so much time and already a 31% probability that you end up at a price of $1,600 for something you just paid $1,000 for. These gonna change a lot. Cause let me see. That's the wrong one. Make sure you're never selling. You're always buying. I mean, you want to buy, don't care. Expiration date. What you doing? You doing a call? You about to put. Which one you gonna do? P stands for put. C stands for call. At $9.75. This is always multiplied by 100. 175. And you're gonna buy 10. You get 9.75K. 9.75. Got 10. Everything you do is multiplied times 10. Yeah, so we doing 27, 342 call. June 27, 342. All right. 38 Delta. $38 a Delta. As long as it moves $1. We got 337, 335. The money is crazy. Now that's times 10. So now making $37 a dollar. You're making $370 every dollar it moves. So you don't need that thing to move $4 for real to make real good money. But if you actually let it ride in the money, you're good. You break down another stock, like it's really this simple. Really just simple. You know how to gauge for how much money you got all the juice out. It's just a matter of practicing now. 15 minutes breaking this down. Let's do we end up over here. Boom. We open up the charts. You see the charts right here. Let's Thinkorswim chart. I know that. We go to trade. We make sure we're in options. Option chain. Option chain. Now we're looking for strikes. This is what price is at currently. We normally do weeklies. We only do weeklies with our earnings because it's high risk, high reward. And boom, got your bid, you got your ask. This is what you getting on. This is how much price they're selling it for, though. To buy it, you might need to pay for $9.60. You got your probability. You got your delta. You got your open interest. You got your value. Remember, high value numbers is high movement for that contract. What else we got? We got a strike price. This is our target zone. Well, I don't think I explained the put, so actually 326. We betting that price will be at or lower than 322 if we pick this one. If we pick, that means we're out the money. Out the money means when price haven't reached that price yet and you betting on it to go to the price. So betting it to go to 322. Dropping down. So drop $4. If you drop $4, you're making 4, 8, 12, 16. $106 plus. That's off the $4 move. I mean, a $4 move, you make $160. And if you buy 2 of them, you make $320 off a $4 move. That's the power of options. That's the power of playing with companies that move a lot too. Because if we were to use something like Cola, it's a lot cheaper. It's a lot cheaper. You see? $60, 100, 2, 3. You don't really see no thousands. Cola we knew was gonna move $3, $4. We can buy $8 of these and buy 100 of them and watch it get pushed up there. You know what I'm saying? You find some small ones like Neo. Look at it weekly. $10, $43.97. And this ain't the money. That's cheap. This is the probability because these motherfuckers move that slow, so I don't really want to, unless it's earnings. Let me think of another. Let's do Apple. Apple not expensive. Look at that. It says it's like going red. We can say if we knew Apple was gonna get $290. Only $100. You can buy 5 of these. So everything you get is multiplied by 5. And once you get to moving, you sell about, you hear me? Buy 5, and you take away 3. You hear me? It's up, and you sell 3. Now you got 2 running to keep pushing down, making you some more money. You're still doubling up. Yeah, man. Calls is on the left, puts is on the right. Betting it's going up, you're on the left side. Betting it's going down, you're on the right side. You want to go cheap and get big percentage gains, you go out the money, about 2 or 3, 4 out the money. 4 out the money for calls. But if you want to, you know it don't move that much, but you know it's gonna move, get 1 in the money or 2 in the money. Depends how you feel. Same way for puts. You believe it's going down, you either go in the money, out the money, or in the money. That's about it.